Hey everyone, welcome to Retire with Style. I'm Alex. I'm here with my trusted companion, the Wade Pfau, and a
Hello.
very special guest, reoccurring one at that. One of our advisors from McLean Asset Management, Jessica Wunder.
Hi. Thanks
Hey,
for having me.
anytime. Wade, you were saying something before I went on my little roll there.
Well, usually I have to tell people my name rhymes with wow. Jess doesn't even have to do something like that. Her last name is Wonder. So Wonder and wow.
Look at us.
Wonder with a U.
Right.
Hey, just this is it just hit me now because I was thinking about Wade, and I'm sure you heard this all the time. So Halloween is coming up. Wonder Woman, how many times?
Yes. Yeah. I one year I was Wonder Woman, and my husband was Wolf of Wall Street. So Alex, this is a good one for you. I feel like you like it. If you had he had a wolf mask on and then a suit, so that was kind of fun. And my daughter has been Wonder Woman quite a few years.
Right? That would be you two should do it. It'd be awesome.
Yeah,
Could
that's
you
fun.
imagine?
Makes it easy.
You'd want to burn that picture quickly, probably. No, I think one year, this is during the Madoff thing, the Madoff mask. You know those masks that you almost like Hollywood thing. You can put them on. There was
Yeah.
a Bernie Madoff one, and
Oh,
I had to buy it. But I don't think anyone would know who that is now. You know that kind of
No,
thing.
yeah.
It's in my basement somewhere. Yeah. Well, today, everyone, we're speaking about exceptional exceptions for early withdrawals from IRAs and Wade. What am I not supposed to say?
Well, you
Not
can
Roth.
add
Not Roth. Wade was like, not Roth, Alex. Don't
Not
say
Roth.
Roth. We're dealing
Don't
with that
say it.
later.
Don't
Next
say
time,
adding
tell me,
Roth to
Jess.
the mix would be too much fun for one episode. So.
Yeah.
Yeah, early withdrawals for 401ks and IRAs. Wade, why don't you set the table up, buddy?
Okay, yeah, I mean, the basic scenario and why we're bringing Jess in to share her experiences is there's a lot of rules, and so how to actually apply those rules in practice becomes important. But if you're under age 59 and a half and you've contributed money to an IRA or a qualified retirement plan and you'd like to take it some distribution before age 59 and a half, well, you always have to pay tax on any distributions, but there's also a 10% penalty that you may have to pay. And that can discourage people to potentially even contribute. The government's motivation is they want to incentivize saving for retirement. So if you're taking out at a younger age, and there may be many early retirees who actually want to look for these exceptions, but if you're taking out at an early age, they're thinking they should penalize you with a 10% penalty. So we want to talk about how you can potentially avoid that penalty. And there's a lot of different exceptions. And I know just has that experience with one of the more complicated of the exceptions about having a series of substantially equal periodic payments. So we want to spend a lot of time on that one, but also make sure we do cover some of the other exceptions as well.
Something I would say as we're getting, as we're quote unquote professionalizing this podcast a little bit here, for those of you listening, we're going to have a cheat sheet of all of these exceptions in the show notes that you can have a link and download it, and you have a nice one pager that has a cheat sheet of everything we're going to say. And in retrospect, yes, we should have done this for probably all previous episodes. It's very data heavy, but hey, with time, here we are, right? But yeah, so try not to go too crazy if you're taking notes or anything like that. We got you covered here. All right, I just wanted to say that so that way people can listen in a more relaxed manner.
Yeah, that's good.
Right. Yeah. I mean, and there's a bunch of these exceptions. So I don't know where we want to start with all that, Jess, but if maybe some that you see most commonly, we start there, or wherever you want to work our way down the list. And yeah, with the notes, with the sheet you have available, some of these exceptions apply only to IRAs. Some apply only to qualified retirement plans. Some apply to both. And so if you get that cheat sheet that's along with the episode, you'll see those earmarked, which is which as well.
Okay. Why don't we start? I don't have the list in front of me, and since we're going to send out the list after, we could. I think that might be easier just to like kind of go through later. But we could talk about either the rule of 55 or 72T strategy is much more complicated. So maybe we start with be rule of 55. That's
Okay.
an easier one.
Mhm.
And one that we can see coming into play. So I think that's an easier one to go through. And then in there, we might touch on some of those exceptions to it, but then we can move on to the 72T.
All right. Yeah.
So the rule of 55, and just like you said in the beginning, if you talk to anyone, even if you just Google and say, oh, okay, can I take money? At what age can I start taking out from my either qualified plan, like a 401k, or my IRA? It's blanket statement is going to say 59 and a half. If you take it before 59 and a half, there's a penalty, 10% penalty, and of course, taxes. We know there's taxes. But the rule of 55 is saying, let's say you're now 57 and you're going to retire early. You say, I have enough in my nest egg. I know I can retire early. You can start taking from it has to be a qualified plan. So it has to be a 401k. In this case, it cannot be an IRA. The others, you can. But in this case, just qualified plan, you can take it from that, and it has to be your most recent 401k. So there are a few rules to this. One, it's age 55. So 54 cannot do it. So 55 to 59 and a half, obviously, those are the years that you can go ahead and tap into this. And from your most recent 401k, you have to be separated from service. So that, at times it may not be as common if you separate from service and you automatically roll it into an IRA. Can't do it. So it has to be the 401k, your most recent 401k. And you can say, I want to start taking a distribution from there, or I need a one lump sum. You can go ahead and do that. In practice, what you do, you just don't click when you're taking a distribution that it's early. Otherwise, that's what's going to go to the IRS, that it's an early distribution. So 55 to 59. Go ahead, Alex.
So Jess, and I'm gonna ask you some questions here,
Yeah.
and some of these could be very specific, and I know they entail if-then statements, so there could
Yes.
be I'll get back to you kind of thing, right?
Right.
But let's say I'm 50. I know that I'm not long for working very much because I don't know. I have $10 million
Yeah.
well, that's an exaggerated example. I have $5 million in an IRA right now, in a 401k for my company, but I'm going to take a new job. And that new job is brand new, and I'm not going to roll. I didn't roll over my previous 401k, and come 52, I only have $10,000 in that account, and that company is done. It was a very bad experience. The company's bankrupt, and now now I'm 52. My most recent 401k is only $10,000.
Yeah.
I'm exaggerating here to try to accentuate points here.
Yeah.
What happens?
Well, you're creating a scenario where you still can't do anything.
Right. Okay.
Yeah. You can't take it. You cannot go back to that old 401k, even though it's still in existence. It's not your most recent.
And that's why I know. Wait, that's specifically what I wanted to hit.
And with the most recent one, you're still not 55 yet.
Oh yeah. I meant instead of 52.
Wait a second.
I'm sorry. I meant 55. Yeah.
Yeah.
I got confused in my own ages. Instead of 52, I meant 55.
Yeah. Right. No. If you say you're 55, even if going to 55, you have 10,000 available to you. Right.
So if somebody is in their whatever age and they have a substantial amount in a 401k, taking another job that's iffy or something like that could be a little tricky if all your assets are qualified accounts. Non-IRA, all your assets are 401k accounts. Because you may not have enough between 55 and 59 and a half in that job. Am I thinking about this the right way?
That's right. For that strategy,
Yeah.
For that strategy, if you only have 10,000 in the new IRA, but 10 million
New 401k.
In the new 401k, and you have 10 million in the old one, that 10 million you can't tap into for the rule of 55. There's other strategies that you can tap into.
I just wanted to get
but
that
for
one.
This one, no.
Although if you can do a rollover into that new employer plan, then you'll be okay.
Yes.
Yeah, but also this only works too if your plan allows for discretionary.
Yeah, I should say that. In all of the cases, it's whether the plan allows it. First and foremost, the plan has to allow these types of distributions.
Okay.
And there's probably one other important point to make on this too, it's not that you turned age 55. So suppose you separated from work at 53, you left the money in the 401k, you're waiting for your 55th birthday thinking you can then begin to take these distributions without penalty. That's not the rule.
That's correct.
You have to separate from service
Correct.
after age 55.
Yeah, exactly. So
Don't get
it's
fired at 54 and a half.
right.
Hang in there.
Hang in there. Show up at 9.
You can do it.
Show up at 9. Go to the office. Go to the office for 6
Do
months.
whatever you can do.
You can do it. You
under the
can
radar.
do it. We believe in you.
Yeah. So, I mean, there are some, it can be a bit strict, on the rules, but you are able to take assets out before 59 and a half without penalty.
Okay. Yeah. I think great. That covers the rule of 55.
Yeah. That one's pretty straightforward.
And though, to just emphasize again, too, this doesn't work for IRAs because it is only for that 401k plan.
Right. And the most recent 401k plan. So almost everything has to fall into the right place for that to work out.
But if it does allow rollovers, you can wrap everything back into that plan if you want.
Yeah.
It's just, you can't always do that.
Right.
And that can help at the margin to get you through 59 and a half.
It can. Yeah. It can.
And so that's kind of the exception that you have on 401ks, but not IRAs. Is there something with IRAs that you have, but not with 401ks? Are there exceptions there for early withdrawals that don't apply to both, just the IRAs and not the 401k? I'm thinking home purchasing, things like that.
Before you jump to that, though, there's one other exception just for the qualified plans.
Oh, the emergency workers?
And that's for public safety employees. And Secure Act 2.0 added a lot of new categories there as well. So certain public safety employees are able to, there's a whole set of rules, different types of jobs and so forth, but can also potentially, at even younger ages.
Right, age 50, like firefighters, EMTs, police officers.
Or now even with 25 years of service. So if they start at a young enough age, even younger than 50. But yeah, that would be the other one for just qualified plans.
Right. Okay. That's what I thought you were saying with your example when you said age 50. I'm like, oh, are we talking about public sector?
No. I was just trying to see if, for people, the tricky part of that rule of 55 is like you have to be kind of fired is the bad news and good news kind of thing.
You don't have to be fired.
You just have to, there's just the age. You have to be, it's pretty strict in the type of account and your age.
Okay. What are the exceptions in the IRA that you see that you don't see in the 401ks?
Yeah, there are 3 there that you're probably referring to, and it's not something that everyone necessarily memorized. So I don't know if you had that list in front of you.
Oh, okay.
I don't have it in front of me. I mean, I know exceptions, but
there's an exception for the home. There's there's a 10,000 for first-time home buying expenses.
Right, for your primary home, right.
Yeah, and you have to do it within 120 days to turn that around. So you don't see that in 401ks. You see that with traditional IRAs.
And that one's more strict, too, that you have to actually directly pay for the home with that distribution. It can't go into your bank account and then other money is used to pay for but up to $10,000 for the first-time home purchase or if it's been at least 2 years.
2 years, right, exactly.
There's one for medical insurance premiums.
If you're unemployed,
yeah.
You can pay for medical insurance premiums for you and eligible family members through the IRA, not through the 401k, but through the IRA.
And there's a few more way that you mentioned too coming up. I think whether it's 2025, 2026, long-term care payments here. So
2026. That's for both. You can pay for long-term care from both IRAs and qualified plans.
Yeah, the one that's specific for traditional IRAs is, like I said, the buying the home, the medical expenses, and there's a piece on education expenses as well.
Right.
And that one's less strict. You don't have to send the money directly to the educational. You said educational expenses would be the third.
Right. Yeah.
And so you can distribute up to the amount of those qualified educational expenses for you or eligible family members without penalty from your IRA.
So before we get into the ones that affect both types of accounts, just to be clear, I'll reiterate it and chime in. I'm somewhat lazy when I'm putting my phrases together, but the exceptions that apply for 401ks that don't apply effectively for IRAs are the rule of 55. That's kind of it. And there are exceptions for public safety employees. Boom. And there's many things within that,
Yeah.
but those are that you can withdraw early if you have a 401k and you're subject to those. But you can't do that within an IRA account. Within an IRA account, you can withdraw early, with issues regarding buying a home, $10,000, distribution for qualifying educational expenses, and lastly, the medical insurance premium expenses. So you can do that. You can tap into IRAs there early, but you can't do that within 401ks. And when I say 401ks, I mean qualified plans in general. Boom. So that's level setting there.
Right.
Now,
yeah.
the ones that apply for both, the early distributions that apply to both of these are, drum roll, and then, there we can break out the examples and stuff like that.
A lot of them.
Yeah, there's a lot. I mean, it's death.
Let's one at a time. Let's start with the big one.
Yeah. We've covered this. Yeah.
Elizabeth, it's the big one. I can't join you. Let's start with that one.
Yeah.
The Sanford and Son exception.
Right. The exception that nobody wants to use is death. And also, disability as well, permanent disability. That's an exception as well. I think you mentioned terminal illness. All the not so great things, let's knock those off the top. Obviously death, disability, illness. And we'll get to, I don't know if we want to talk about it now, but the 72T, because that's one also that covers both. That's taking equal payments from an IRA or a 401k. That's complicated. So I don't know if we want to go through the rest of the list that's not as complicated, and then circle back. You tell me.
Well, yeah, let's save the best for last, because with these others, we just kind
That's
of
a
name
lot
them
of
off.
fun. That's a lot of fun.
Yeah, but then there's also for deductible medical expenses.
Yes.
This would be the amount over 7.5% of your AGI. You don't have to actually deduct them, because it might still fall in your standard deduction. But what would be deductible medical expenses is an exception. There's now, with recent law changes, you've got things like $5,000 you can take out with a newborn for eligible expenses for a newborn. You've also got...
Yeah, that's definitely a new one.
With Secure Act 2.0, there's some new exceptions. Emergency withdrawals up to $1,000. That actually, just in 2024, it's the first year that one exists, as well as some potential benefits for victims of domestic abuse to be able to take distributions without penalty.
Right, and that's 2020, new in 2024.
And then, Jess, could you talk a little too about the disaster recovery?
Yes, that's also I guess somewhat timely, unfortunately, but with the hurricanes, there is a disaster recovery relief also. That's an exception to the early distribution. That's one that I think we certainly this year, I can imagine people are thinking about. And, we've seen it just with clients in North Carolina, with quite a few clients in Florida as well, but mostly North Carolina that got hit there at Asheville, that this is a good way to be able to, unfortunately have to tap into those assets for an unfortunate reason, but you can, starting, I think it was, it's not this year, but it's relatively new, the disaster recovery relief. And I think it's up to 22,000. I'm going by memory.
Yeah.
So
okay, that saves the best for last.
Just to then say these all at once. So then, the exceptions that apply to both, and again, chime in. I'm trying to give it the overview here. Death of a participant. Obviously, that's an exception. Now, there are beneficiary workflows that happen afterwards that we won't get into in this episode because it can get complicated. But just know, for purposes of this, and it's stating the obvious, but there's an exception for early withdrawals if you die before 59 and a half. You know,
Right.
Yeah, just
permanent.
one more sentence to that. So
Go on.
spousal beneficiaries have a lot of options to them, and they
Yes.
need to be careful
Right.
because if they're under 59 and a half, they don't want to just roll it over into their name right away because then they'll be exposed to penalties.
And
Right,
that's why
exactly.
there's a lot of things that happen afterwards.
Yes.
It's almost its own thing.
Mhm.
Permanent disability of a participant is another one, and there's like things that you have to qualify for to be able to
Correct.
be permanently disabled. Terminal illness. Again, this is a terrible list to read.
Yeah, I know. Let's go to the
I
newborn
get it.
expenses.
You
Let's
know,
go.
terminal illness, and that's a doctor. There's a certain number of years. I don't know it off the top of my head. Wait, the doctor
I
will
think
say
seven.
it doesn't. Say it again.
7, I believe.
There's a certain number of years that the doctor will give you a life expectancy,
Yes, right.
and you play off of that. And then you just talked about the medical expenses, and so those apply.
That one was back with the IRA only.
Oh, I meant, sorry, distribution
that.
less than the deductible for medical.
Yeah, the
expenses,
7.5%.
Yeah. I was trying to do it quickly, so yeah, I only cut,
Oh yeah,
I
okay.
cut off half
I'm
of it.
sorry. Oh, you're right. Yeah, not right. Deductible medical expenses.
Right.
Yeah, and you don't need to take the deduction; they just need to be "quote unquote" deductible.
Yes.
All right, that's
Which means over 7.5% of AGI, not just any like eligible medical expense.
Got you. Yes, thank you. And so that's the ones that apply to both. And then there's one more that we're gonna now flesh out a little bit more right now.
Well, and there's the newborn expenses.
Yeah.
Oh yeah. There's the newborns okay.
And there's the
Domestic
emergency
violence,
withdrawals,
yeah.
victims of domestic abuse,
Like I said, there's two more.
disaster recovery.
Right. I can't memorize these.
There's a
It's going
few
to be a
more.
test,
There's
Alex.
a few more.
Man,
I think we hit them all.
Jesus.
I think we fit. Yeah. We do? Well, I guess it's newborn, but birth or adoption. There's.
Adoption. Yep.
Yeah. Okay. So there's a few. We'll have the list. There's actually a pretty lengthy list, which is helpful. It's helpful.
Yes. All right. So, Jess, what? Go on. And now, what's the big one that you were going to discuss?
Okay. So the big one that's pretty complicated is the 72T approach, and that's taking substantially equal payment plan. That it doesn't have the same rule of 55. So when you said age 50, I thought that's what you were getting into. This is pretty complicated, and it's one that you don't want to mess up, because if you trigger something or do something off of the rules, you'll end up with a penalty for the full amount. They'll go back from when you started, and you'll have a penalty that 10% will apply to the full amount. So it's a great strategy. I'll walk through just a scenario of what we've done in the past. And just disclaimer, I've done it about 2 times in 25 years. It's not common for our client base, but it really is a great strategy. If it works out, and Alex, I'll use yours of, you have, let's say, a tremendous amount at 5 million, whatever that is.
Doesn't mean my personal example.
This is you. Yeah. We're going to use that.
Because Wade knows it's definitely much, much, much more.
Correct.
I thought that 10 million IRA you were talking about earlier was.
Yes. Well, in this scenario, and there's actually the 2 separate scenarios with different situations, but let's make the assumption that it's someone can retire early. They know I have the financial freedom, and they're ready to retire. They know they have more than enough in their nest egg. In their retirement account, IRA or 401k can be used for both, or retirement plan. I said 401k, but Wade, like you said, it does cover all qualified plans. So IRAs, qualified plans. In this case, there was a significant amount of assets there. We knew that this would work. I do want to bring up, and I could probably talk about it at the end, but I'll bring it up quickly here, that taking money out, and then wait, Alex, you know this better than anyone here, that retirement can last 30 to 40 years. Taking out a chunk in your early 50s can really change that your long-term retirement plan. Just throw it out there. Let's say it. I can bring up examples, but you take 50,000 out at age 50, at age 65, that could be almost $200,000.
Yeah,
if invested. But just throwing that out there.
I'm a strict acolyte of the Fire Nation. So
yeah, that's what this is in the FIRE community. That's where you'll see the most discussion of this, because it's for people who are retiring before they're 59 and a half. It's if you just need a one-time distribution, you don't want to set up. I think you'll get into that.
Oh yes, yeah. You don't want to set this up, right? This is for and in this case, we've exhausted all the other options. So the rule of 55 just doesn't apply, whether it's in an IRA or maybe they're not 55. Doesn't apply. Can't do that. I know we didn't touch on any of this, but a 401k loan doesn't apply, a HELOC, other options where there's no other taxable funds, an emergency fund that there should be, but we're just going to pretend that none of it's there. None of it is there.
Of a last resort kind of thing.
It is. In my opinion, this is more of a last resort, although it works well, but I would look at the other options before doing this. But let's make the assumption we have a good amount of money. We're going to start doing this. So what we want to do, there's a multi-step approach to it. And I'll go back to why, after I walk through the process of it, why there's a multi-step approach to it. One is figuring out, so in this case, sat down with the client and said, okay, how much do you need? How much do you need from annually? Let's come up with an annual number, 40 to 50,000. I'm going to say just 40,000 a year. Let's just pick it. 40,000, and we know we need that amount each year. There's a calculator, a 72T calculator. If you Google it, it'll pop up quickly. Actually, Bankrate has it. I think any of the custodians has it. You can go and click on there, and you put in your information. And I'm not going to dig into the calculator because we'll be here another hour going through the calculator. But you say what we're trying to figure out is what is the lump sum needed for those annual payments. And there's also a few different options that you can choose for these payments. One, the easiest one and the one I'd recommend is taking it like a required minimum distribution. So we know at age 73, out of your IRA, you're forced to take a required minimum distribution. So this is the easiest way to do this. This is just saying, based on the value of the account on December 31st, the year prior, and then it's divided by life expectancy factor that we find on the IRS website. The calculator will figure this out for you. So I'm giving you information, you don't need it. You just go to the calculator, plug it in, and it'll spit out your three different options. One, the recommended easiest one to do. Second one is fixed amortization. So that's just taking the account, amortizing it over your life expectancy. Third is fixed annuitization, which is basically the same thing. Essentially, it's more complicated because then there is a separate calculator that will pick up as if this was an annuity. For the case that I've done in the past, just pick the RMD. It's the simplest one to do. And you can actually, it will change.
Only a caveat there. And again, this is a last resort type of thing. So it's people that are, and I'm saying that I'm exaggerating.
Yeah.
I'm kind of like doing I'm generalizing. I shouldn't, but
yes,
let's just say 80% of the time, it's one of these where something has hit a ventilation system. And so you need
just, if you are an early retiree, this could be part of a responsible retirement plan. So
there you go.
Yeah, it could be last resort, but it could also be, someone could be saying, hey, this is not last resort.
Yeah.
It can be justified.
Right, yes.
But that being the case, what you're ultimately getting at there is that you can lock in with the RMD approach, you can lock in the thing. And so with the amortization and with the other one, is there one that's usually higher than the other? I say that to lead into, if you need this because there's maximization of amount, then what should that person be thinking of?
not the RMD one.
Yeah,
That's probably
exactly.
going to be
That's
the lowest out of the three, but is the easiest one not to mess up. For sure, the easiest one not to mess up. The other two are going to be similar payouts, and they'll be higher.
And you are allowed to start with one of those other two and switch
to the R. Yes, there's a one-time switch that you can. If you start with the other two, you can go back to the RMD. You can go back that way. So let's assume you've done the calculator. You're going to pick one of the three. You know your lump sum. The next step is pretty important. And you don't have to do this, but I recommend doing this, and I'll tell you why in a second. Taking that lump sum out. So if it's $200,000, whatever the amount is, putting that into a separate IRA. So you're leaving, if you have this massive IRA, you only take out the portion that you know you need you have to keep it in this plan for 5 years. 5 years, 59 and a half. You have to keep it in this plan.
Whichever is longer.
Yes. Whichever is longer. So you start at 58, you have to keep it there till 63. So you take whatever that lump sum is, you move it into this IRA, and you start taking your distributions. Come tax time, it is not coded. Make sure it is not coded as an early distribution. Otherwise, you're going to get hit with that 10% penalty. But the important piece, and why I say to move that chunk into a separate IRA, is because you really do lose flexibility out of those assets. So if you need more than that, you can't get it. Once you do that, if you trigger, and this is what I said, it can be complicated. And also if you mess it up, you're going to owe penalties on all of that amount. If you need more and you're taking it from your large IRA, you can't tap into it. We're making the assumption that there's no other assets for you to tap into. So if there's an emergency, you can't get to those assets. But if you have it in a separate IRA, you have that $200,000 that is now paying you that payment over the next 5+ years. Then if something else pops up, you can go and tap into the other IRA and take out of that. Now you'll have the penalty there, but it just gives you more flexibility. So it's pretty important. And it's not a step that you have to do, but I recommend making sure that you do it that way. And that we've seen, and like Wade said, that it can be, I think you used responsible retirement plan. We're making the assumption there's two ways to look at it. Is one is that there's a cash flow need, and it's kind of an emergency type of situation where we don't want to take out, but this is our last resort. But also could be, which is how we've used it in the past, is I have more than enough. I want to retire. I want to go do things. I want to retire. I know I have more than enough. We've done the financial plan. You're set. Sure, you can start doing something like this. This makes sense.
More than enough, but concentrated in an account.
Correct. This is always the assumption that the assets that you can tap into are just tax deferred, whether qualified plan or an IRA. That's it. But, Alex, on that, it does lend to thinking about saving not just in a tax deferred account, whether it's an IRA
100%.
or 401k, but there's even, I know we weren't going to talk about it, but a Roth, there's options there. Just making sure that as you're saving for retirement, that it's not just in tax deferred assets. And many of us, that's all we do. And that's okay, but it can lead to this type of situation where you're stuck trying to find an exception to take out of those types of plans before 59 and a half without penalty.
And I think we've always, just as a general matter, and Wade, I think we have, when we talk about tax diversification, from
Correct.
the standpoint of what types of accounts should you fill up, we kind of always default to just keep it balanced. Because if you don't have anything that's taxable, you could potentially run into spending sort of issues that you can't resolve right away because of the logistics of having something in a qualified account, if you will. Wade?
Right, exactly.
I think that's kind of our theme usually.
Yeah, I mean, it'd be helpful to have some taxable assets as well. And
Yeah.
as Jeff is pointing out, I mean, in principle, there's nothing wrong with this other than there's so many ways you can make a mistake and then get a big penalty. So that's the real danger of setting up a substantially equal periodic payment.
Yeah, and for the client that we're talking about, yeah, this was
Right.
somebody that they were going to spend more money than their kids could even use, and it's one of those. They worked for a company. The company took off like a rocket,
Right.
and it happened to be everything in the 401k. And this person was, I don't know, just a normal
Yes.
employee,
Yeah.
probably not making more than 110,000 in any given year for the entirety of their career. And so
Exactly.
it was one of those that, and was living, nicely, but nothing opulent, nothing overly restrictive. So like a normal thing, but you hit it big in the 401k land, and that person wanted to call it a day. I forgot how old that person was. Let's just
Early
say,
50s.
yeah, right, early 50s. And so, yeah, we implemented it simply because it served the cash flow needs of
Mm-hmm.
having money until 59 and a half. And at that point, they could, a better decision could be, it could be like as an inflection point to then review again.
Yeah, and you just have to take it out for the longer. So if you started this at 50, you can stop. You're no longer required to take those distributions once you're 59 and a half.
Exactly.
If you started it at 58, though, you are required to continue it for 5 years, so until 63 before you.
Right. Yeah, that is a big one. That's a big one because I think people would automatically assume, oh, I'm 59 and a half. I don't need to do this anymore. Well, you do if you started this type of plan.
At least 5 years.
Yeah. Right. Right. But it's a good way. It's a good way to start tapping into those retirement assets before 59 and a half without penalty, making the assumption that that is the last place you can get it from, the last resort.
Okay.
There it is.
Yeah.
Yeah, and at one point it did come up just in 2026. They're going to add a new exception with the qualified long-term care expense distributions, but we're still a couple years until then. And until that point, I think we covered it. So
and I wonder if that one, I mean, I'm probably bringing up more of a long-term care expenses would probably hit under the medical expenses. I wonder if that would hit the 7.5 anyway, but that's for going.
Well, and this is also relevant if you're under 59 and a half and you need long-term care. So it's not the normal long-term care scenario of advanced age.
All right. And again, we'll have a cheat sheet in the show notes to make sense of all of this for you folks. So feel free to knock it out. You have a link and you can go to it. Thank you, everyone. Thank you, Jess, for giving us, the lowdown on this. Really appreciate it. Wait.
Yeah, and Jess, if there's anyone listening who'd like to reach out to you to talk about potentially like working with you as a financial planning relationship, how can they best do that?
Our website is the best way to go about that, and our website is McLeanAM.com.
Okay, and as I said in the last one, it's a difficult
Nobody
spelling.
knows how we spell McLean, so we should spell it out.
Oh, McLean and then AM. I always have to say AM is an assetmanagement.com.
I make the same mistake all the time too. Not the same mistake, but I always go through
people more naturally want to put an A in there.
AM.com, and then you have to explain AM is different than AN. Yeah, it kills me. All right, everyone. Thank you for listening, and we'll catch you next week on Retire with Style.